Have you ever sold something to someone but they promised to pay you later? Businesses do this all the time, and in accounting, that unpaid money is called accounts receivable or AR. Accounts receivable is money owed to a business by customers for goods or services that have already been delivered but not yet paid for. In simple terms, it's money the business is expecting to receive. Think of it as the opposite of accounts payable. For example, imagine a company sells £2,000 worth of products to a customer and gives them 30 days to pay. The company has already made the sale, but the cash hasn't arrived yet. That £2,000 becomes accounts receivable. Now, why is this important? Because accounts receivable is considered an asset. Even though the business hasn't received the cash yet, it still has a legal right to collect that money in the future. So AR represents future incoming cash. Now let's look at how it's recorded. When the sale happens, the business records two things. First, it records revenue because the product or service was delivered. Second, it records accounts receivable because the customer still owes payment. Here's the basic idea. The business sells goods worth £2,000 on credit. Revenue increases by £2,000. Accounts receivable also increases by £2,000. Assets increase its revenue earned later. When the customer finally pays, cash increases and accounts receivable decreases because the debt has been settled. So why do businesses allow accounts receivable at all? Because offering credit can increase sales. Customers often prefer flexibility instead of paying immediately, but there's also risk involved. If customers fail to pay, the business can face cash flow problems or bad debts. That's why companies carefully monitor accounts receivable and often set payment terms like 30 or 60 days. A common misunderstanding is thinking accounts receivable means the business already has the money. It doesn't, it only has the right to receive it. Another misconception is confusing accounts receivable with revenue. Revenue is earned income, while accounts receivable is the unpaid balance connected to that income. So, what's the key takeaway? Accounts receivable is money customers owe a business after receiving goods or services on credit. It's recorded as an asset because it represents future cash coming into the business. And once you understand accounts receivable, you start to see how businesses often earn money long before they actually receive the cash.